Distressed properties are often the best opportunities for investors using creative financing. Here's a breakdown of the main types. 1. Foreclosures. Properties owned by lenders after the previous owner defaulted on their mortgage. How it works. These properties are usually sold at auctions or directly by the bank, known as REO real estate owned. Pros, often below market value. Clear title if REO. High potential for profit if the property is in decent condition. Cons may need significant repairs. Auction purchases often require cash. Limited inspection opportunities. Example. You buy a $200,000 foreclosure for $120,000, spend $40,000 on repairs, and sell for $250,000, netting a $90,000 profit. 2. Short sales. A property being sold for less than the mortgage balance with the lender's approval. How it works. The owner negotiates with the lender to sell the property at a reduced price. Pros, significant discounts on property value, more time for inspections compared to auctions, opportunities to negotiate terms with the lender. Cons, lengthy and complicated approval process. Not all lenders approve short sales. Properties may have liens or unpaid taxes. Example, negotiate a short sale for $150,000 on a property worth $200,000. Use a hard money loan to close, then refinance with a traditional mortgage. 3. Pre-foreclosures. Properties where the owner is behind on mortgage payments but has not yet been foreclosed. How it works. Negotiate directly with the seller before the property goes into foreclosure. Pros, direct negotiations allow for flexible terms like subject to deals or seller financing. Can avoid the competitive auction process. May not require much repair work if caught early. Cons, requires excellent negotiation skills. Sellers are often under financial stress and may be uncooperative. Limited time to close before foreclosure starts. Example. Approach a seller with an $80,000 delinquent mortgage on a $200,000 property and take over their payments, subject to. Probate properties. These are homes owned by deceased individuals and are often sold by their heirs. Now, how it works is quite interesting. These properties can be sold through probate court or directly by the heirs themselves. There are some pros to consider. They are often sold below market value for quick cash, and sellers are usually motivated to liquidate the asset. You can even negotiate terms like seller financing. However, there are also some cons. The process can involve legal delays during probate court proceedings, and the property may require extensive repairs if it was neglected. For example, you might negotiate with an heir to buy a $250,000 property for $180,000 in cash. Tax delinquent properties. These are properties where the owner has failed to pay property taxes. So, how does it work? These properties are sold at tax lien or tax deed auctions by local governments. The pros? Well, you can purchase them at a very low price compared to market value. There's also the potential to acquire the property free and clear at tax deed sales, and you can clear delinquent taxes through negotiation. However, there are some cons to consider. There's a risk of other liens or encumbrances on the property, and you may need legal action to gain ownership. Plus, these properties are often purchased sight unseen. For example, you could buy a tax lien for $5,000 on a $100,000 property. If the owner doesn't pay within the redemption period, you acquire the property. REO or real estate owned properties. These are bank-owned properties after a failed foreclosure auction. So, how does it work? Banks list these properties for sale, often at a discount. The pros include a clear title, as banks resolve liens before selling, and the ability to finance with traditional loans. You can also negotiate terms with banks. But there are cons too. They're often sold as is, requiring repairs, and may be priced close to market value, which limits profit margins. An example would be purchasing an REO property for $150,000, investing $20,000 in renovations, and then renting it out for $1,800 a month. Abandoned properties. These are vacant properties where the owner has walked away. How does it work? You can locate and contact the owner directly or purchase through government auctions. The pros include significant discounts and often highly motivated sellers. There's also the opportunity to add substantial value with renovations. But there are cons as well. Finding the owner can be challenging, the properties often require major repairs, and legal issues with title or liens are common. For instance, you could locate an abandoned home worth $150,000, offer $50,000 cash, spend $30,000 on repairs, and flip it for $180,000. Bankruptcy properties. These are properties owned by individuals in bankruptcy proceedings. How does it work? Courts or trustees sell these properties to pay off debts. The pros? Often they're sold below market value to satisfy creditors. Legal oversight ensures a clear title, and there's usually less competition than at foreclosure auctions. But there are cons too. The court processes can be lengthy, there's limited ability to negotiate terms, and you may need court approval for the purchase. For example, you could buy a property in bankruptcy for $200,000 with a market value of $250,000.